Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At Personal FN, we are committed to helping investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to this special series of life goals brought to you by Money Simplified, your guide to money and mutual funds. We are glad to have you with us for the fourth session on retirement planning, and that is allocating assets for your retirement portfolio. Alright, so let's get started. In an endeavor to live peaceful retired lives, many of you may be investing in a host of investment avenues. But the question is, are you allocating your hard-earned money to the right asset classes? You see, asset allocation is an important ingredient in the endeavor to achieve your financial goals. It helps you to minimize risk in your portfolio and optimize the returns, besides offering a host of other benefits which come along. While benefits of diversification have been talked about widely for its merits, it quite often has been incorrectly or incompletely followed by many investors. If your asset allocation has gone awry, there is a high chance you may not be on the right track in your retirement journey, and you may be left with a suboptimal corpus during your golden years. So in this session of Money Simplified, we will help you meaningfully chart your asset allocation, which would help you achieve your ultimate goal of retirement effectively. The importance of asset allocation for your retirement portfolio. One cannot ignore the risk which comes along with investment idea, no matter how luring or promising it sounds. You need to balance your risk reward, keeping in mind your age, your income and expenses, assets and liabilities, risk profile, and your investment time horizon. Prudent asset allocation can help you diversify your investment surplus meant to plan your retirement wisely and across asset classes like equity, debt, gold, or even holding cash equivalents for that matter. Having exposure to more than one asset class optimally can work in your favor because different asset classes react differently to the same set of factors in play and hence are subject to varying levels of risk. Asset allocation reduces dependency on a single asset class. That can help you manage your liquidity needs better during retirement, and thus asset allocation can set the right investment strategy. Here are 6 key benefits of asset allocation. Benefit number 1, minimizes your portfolio risk. If retirement portfolio is well diversified into various asset classes such as equity, debt, gold, or even cash equivalents, risk can be reduced. A prudent asset allocation helps you protect from market ups and downs. Benefit number 2 is optimizes your portfolio returns. Through asset allocation, you can ensure that you do not invest in an ad hoc manner, or else your retirement goal may not be achieved. It helps you place a rational return expectation. Benefit number 3 is helps align your investments as per your time horizon. Along with the risk profile, which is an essential facet while investing, the time left until your retirement is considered. This helps to draw a prudent asset allocation for your retirement portfolio. As a ground rule, remember that if you are left with a sufficient or a long time for your retirement, say more than 10 years, a predominant portion of your investable surplus can be parked in equities. On the contrary, when the time left until retirement is quite short, less than 5 years, it is best to avoid investing in equities and instead prefer investing in fixed income instruments. If you are left with medium-term horizon, that is 5 to 10 years, you could maintain a healthy balance between equities and fixed income. However, as time passes, you need to review your asset allocation, and that should be done based on your age, change in financial circumstances, windfall gains, unexpected losses, besides change in outlook for a particular asset class. This helps you align your retirement portfolio wisely. Benefit number 4 is makes market timing almost irrelevant. A prudent asset allocation plan, charted taking into account your risk profile, your financial goals, and your investment time horizon, amongst a host of others, which makes timing the market almost irrelevant for you. This thus ensures that there is no digression from the financial plan charted for your long-term financial well-being. Benefit number 5 is helps maintain adequate liquidity. Liquidity is one of the vital factors while making investment decisions. Sufficient liquidity helps you address your retirement needs. And benefit number 6 is minimizes your tax outgo. A high incidence of taxation can be avoided if investment planning for retirement is done well through tax saving instruments or right asset class mix which facilitates minimization of taxes. But understanding which asset classes are suitable is not easy. You need to understand the risk return trade off of every asset class. As you can see, money market or cash equivalent or fixed income and debt instruments carry low risk and thus generate low returns vis-a-vis high risk asset classes like equities that have the potential to generate higher returns. The return potential of asset class in your portfolio will be subject to the risk you are willing to take. Moreover, you should keep your return expectations realistic. You should calculate the required annual growth rate to build a respectable corpus for your retirement, and while you do so, account for inflation wisely. Defining your asset allocation. Well, this is a daunting task, but one of the best ways to do it is by recognizing the age bracket you happen to be placed under. For individuals between 25 to 35 years, having time horizon of 25 to 35 years, as an individual, if you happen to be in this age bracket, you are in the accumulation phase of your life cycle. Hence, you may be looking for wealth creation in the long run since you have sufficient time before you hang your boots. Apart from retirement, you may also have financial goals in the interim such as buying a dream home, car, getting married, and even save to begin a family and eventually plan for your child's future needs. So given such a scenario, you would need to prioritize each of your financial goals. Nevertheless, with a sufficient time horizon until your retirement, you can afford to take a higher risk with your retirement savings. Therefore, there is scope to position your portfolio aggressively by allocating 65% to 85% of your portfolio in equities and around 5 to 20% in debt. Based on your preference, you may also hold around 10 to 15% exposure to gold to diversify further. Then, for individuals between 35 to 45 years having time horizon of 15 to 25 years. If you are in this age group, you are in the mid-asset accumulation phase of life. You may be planning to buy a house, a car, and invest for a child's education. You need to plan your income well and streamline it towards achieving your goals and lifestyle. With a time horizon of around 15 to 25 years on your side, you can take a relatively higher risk to grow your retirement portfolio. Hence, your portfolio can be positioned in the moderately aggressive risk profile by allocating 60 to 70% in equities, 20 to 35% in debt, and holding 5 to 15% in gold. Then for individuals between 45 to 55 years having time horizon of 5 to 15 years. If you are in this age group, you are in the protection phase of your life cycle. In this age bracket, you may still have life goals to fulfill such as child's higher education, their marriage, or even moving into a bigger house you've dreamt of. Hence, this is the phase when you need to streamline your finances, both inflows as well as outflows. You see, you need to keep aside sufficient funds for your retirement portfolio because there's a possibility that you may fall short on the corpus for retirement. But since you have a time horizon of 5 to 15 years, you can afford to take some amount of risk rather than being too conservative. Hence, your portfolio can be positioned moderately by allocating 40 to 60% towards equity, 35 to 50% towards debt, and about 5 to 10% in gold to hedge the portfolio. Then for individuals between 55 to 60 years having time horizon of less than 5 years. If you are in this age group, you are on the verge of retirement. These are your few final years before you hang your boots. Soon, your regular source of income would stop. Hence, you ought to be conservative while investing your hard earned money. It would not be advisable to have a high exposure towards equity. You should position your portfolio as 20% to 30% in equity, 60% to 80% in debt, 5 to 10% in gold as a hedge. For individuals above 60 years and already retired, if you are 60 years and above, in all likely chances you may be retired. You have completed the conservation and protection phase of your life and have entered the distribution phase. By now, you have limited income or even no regular income, and thus at this stage, one dips into his savings and reserves that has been built over the years. Hence, while you invest to take care of your retirement needs, your portfolio needs to be positioned conservatively. Around 70 to 80% of your portfolio should be inclined towards fixed income generating instruments to generate post-tax returns of at least 7 to 8% per annum. Assuming annual inflation expectation is at the rate of 7%, some portion, say 10 to 25% of your portfolio, can be in equities with a long-term investment horizon of at least 5 years and about 5 to 10% in gold as a hedge in your portfolio. But do not forget to rebalance your portfolio. In this exercise of asset allocation, a need to rebalance the portfolio may arise. Rebalancing refers to realigning or adjusting the holding in your portfolio. You should rebalance your portfolio as your age progresses or change in risk appetite led by various circumstances, nearness to financial goals, or even when the outlook for a particular asset class alters significantly. It helps you to book profits, sell high in an outperforming asset class, and or buy more of an underperforming asset class, that is value buy. Hence, you should review your portfolio on a regular basis, say on a yearly basis, to check the need for realignment. This is because the allocation to an asset class may drift significantly away from the initial allocation due to appreciation or depreciation in its own value, or appreciation or depreciation in the value of other asset classes. Rebalancing would help you manage the risk to your portfolio and smooth out your portfolio returns. Lastly, before we end this session, here are some points to remember. Don't just invest in an ad hoc manner for your retirement, invest prudently, charting an asset allocation most appropriate for you. While drawing your asset allocation, consider your age, income and expenses, assets and liabilities, risk appetite, and time horizon. Asset allocation is an important ingredient to achieve your ultimate financial goal of a peaceful retirement. It reduces dependency on a single asset class, will help you minimize risk and optimize returns of your retirement portfolio, makes market timing almost irrelevant. It will help you maintain adequate liquidity in your retirement portfolio. It sets forth the right investment strategy, but ensure that you review your retirement portfolio and, if need be, rebalance it appropriately. So to end our learning exercise today, we now invite you to test your learning by taking up the simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.